Hello, welcome to another edition of Nucleus Investment Insights. So, market turmoil. It's hard to go past some other things planned to go through today, but I think it seems silly to discuss anything else. And so, what I really want to talk about is, some of what's happened. So, I spent a fair bit of time last week going through why we're selling and I guess the concerns we have. But I thought I'd sort of touch on some of the bigger picture issues this week, and to sort of really talk through some of what should you be doing, how should you think about this, how much of this is a buying opportunity, how much of this is what's in it for traders, that type of factors in terms of really the at the coalface, what should you be doing? Because getting a lot of questions obviously from clients given the concerns. So, yes, more market turmoil. Just a reminder, everything you hear today is general in nature, the advice. None of it's personal. If you do want personal advice, have a look in the show links, and you can book in for a meeting, and we can have a talk about your own personal financial situation and what might need to be done for you. So, where are we, I guess, is the big picture. I think where I'd like to start is sort of a quick recap, I guess, of how we're looking at it from the investment perspective. And then I want to sort of talk about valuations, where are the risks, where are the dangers, where are the opportunities beyond this. So, big picture wise, when you see these crises start to emerge, and periodically we're going to get 10% falls and 15, 20% falls sometimes. The question is this a buying opportunity in sort of a, in the longer term rise of markets, or is there something bigger at play, and, can you be going into some sort of relatively major crisis, and so therefore you might need to step back even further. There's questions about timing the market and jumping in and out, which is the idea around saying, well, look, if I think the market's going to be down 20% and I sell today and then I buy back in at the bottom 20%, great, I've just picked up an extra 20% that I would never have had. And what are the risks and the returns around that? And there's sort of like this idea you've got to make two decisions: one decision to get out, the other decision to get in. Depending upon what you're buying and selling, I'll run into that in a bit of detail. You can often be raising some relatively large tax issues for yourself, and they're sort of guaranteed. So anyway, we'll run into that in a minute. But I guess the big picture, markets, they rarely move in this sort of straight line, and so they have had a pretty big pullback in a very short period of time. And so, it's not atypical to see some sort of face-ripping rallies where markets might be up 3 or 4% in a day, and then they'll spend the next week sort of falling again, and then all of a sudden you'll have these massive rallies. So don't get too caught up with one-day movements. It is about taking this longer-term view on things. So, in a broad sense, what is the Trump or Scott Bessent plan? I guess is probably the better way to look at this. And what it's about is emphasising a sort of corporate-led economic growth with minimal government intervention, trying to get US corporations to be free to innovate and drive productivity, trying to bring as much production back to the US, so not offshoring everything and actually building more in the US. And the idea is that by cutting back on government spending, reducing taxes, reducing regulation, you're going to let the private sector free to thrive. And if you're going to do this, the best time to do it, in a political sense, is in the early years, so that then the growth kicks in later on in the term, and they're going into the next election with some solid economic growth, or at least part of the way there. So that's the plan. Execution risk is what we spoke about last week. That's where the danger is. So the danger of this chaotic tariffs are on, tariffs are off, tariffs are back on again is what's the problem, and the problem of driving a coherent narrative through that people can understand. And my example is the company that wants to build a factory. they're thinking about, do they build it in Mexico and say it's going to be 20% cheaper in terms of ongoing costs if they build in Mexico. Okay, great. So if they know tariffs are 25%, they're on, there's no sort of risk of backflipping and turning around. Great. I don't build the factory in Mexico because 20% lower at a 25% tariff. I'm better off building this thing in the US and taking it from there. So that makes a lot of sense. But if you're worried that the tariffs might just disappear, so it might be 25, it might be zero. Well, if I go ahead and build this factory in the US, I've now got a factory that's 20% more expensive than my competitors who built the factory in Mexico. And so, on one hand, I build the factory in Mexico and I'm stuffed. If the tariffs are on. Secondly, if I build it in the US, I'm stuffed if the tariffs are off. What do? Chances are you just wait. Is it, unless you absolutely need to build it straight away, let's just wait for more clarity. And the problem you get is if too many companies end up in that, we're just going to wait, you're starting to run into this economic sort of hole. So there's that. You add to that the consumer uncertainty. So some pretty big drops in consumer confidence. Elon Musk obviously having a reasonable impact on the confidence of basically all the public service. So, big chunk of the US federal government employees, which they're not such a great proportion of the economy, all got this letter to say, justify your job. And so obviously they're going to be nervous about their ongoing prospects and probably not outspending as much as they might have otherwise done. But then you add in other sectors. You've got contractors that are paid by the federal government who, they're getting the ruler run over them as well. You've got a lot of grant recipients where, there's some, particularly in the medical space, there's a lot of sort of stories coming out now of just, bright young scientists who have made it through, got their PhDs, trying to do the grants, and they just can't get it, and they're just not getting the money that they used to get, and they're going to have to go find jobs elsewhere. And so it's sort of like there's 10, 15 years of study that some of these PhDs have been through is sort of now lost to that sector. And so then you add in the local government and the state government, and you sort of end up, you add all three of those together, all four of those together, and you sort of end up with almost 20% of the US workforce that probably has at least a lot more concerns than they did sort of pre-Elon Musk. You've got interest rate uncertainty. So now the Fed's going to be sitting here with these conflicting signals. If it's thinking about cutting rates, now it's going to have these complications due to inflation pressures from tariffs. So inflation's going to take this jump. Much harder to cut rates when inflation's taking this jump. Secondly, because the tariffs are now on countries that most wouldn't have thought were going to have 25% tariffs, particularly Canada and Mexico. Now the question is, well, a company's going to find that they've got these big supply chain issues and they've got to start shifting their supply chains around. And we saw post-pandemic where that really caused some issues with inflation. So if we've got some supply chain issues adding to inflation as well, the Fed's going to, and then we've got corporate profiteering. I've spoken about this in the past, where because there's inflation coming through, you get this greedflation. Companies can now justify putting prices up to their customers. They have an excuse. So we end up in that position where what we're looking at is a Fed that's going to be sitting there going, well, what is the inflation I want to ignore, which is sort of the direct impact of tariffs, which are going to give you a one-off effect and then go away, versus supply chain issues, versus corporate profiteering, versus other stuff that's going on. The avian flu and the price of eggs and all these other things that's happening, and plus then you're going to add in less immigration, so more wage growth. There's so many different sort of factors that are going to sort of give them enough uncertainty that chances are, if it's choice between doing something and not doing something, they're more likely to not do something in the face of uncertainty. And then there's this legal uncertainty going on as well. Department of Justice has had some considerable turnover. You've got a lot of people being fired within that. There seems to be, well, certainly, I I think most unbiased observers would say that selective prosecution and retaliatory actions against critics are certainly out there, and retaliatory legal actions. And so they've got this reduced set of lawyers trying to prosecute things that don't seem to be. Well, I'm trying to say this as nicely as I can without saying that. Let's just say it's selective prosecution, which doesn't put a lot of faith into companies. Companies like to see the rule of law. They like to see justice. They don't like to see say legal firms being pursued because they've followed up lawsuits on Trump in the past. There's a lot of there's this whole idea of court stalemate there. And so none of this is sort of going to be helpful for companies that are thinking about taking risks and spending more. I haven't even discussed Ukraine, military spending, all those types of factors as well. Will Russia re-enter the global market, particularly commodities? Is Trump going to follow through on his statements? All this uncertainty about, one week Trump's talking about Zelensky being a dictator, and a week later he can't even remember saying it. I think there's the flip-flopping idea is that if there was a coherent big picture government strategy that had been expressed and people could sort of follow through the steps and say, yes, whatever the change that just popped out, that fits into the overall big picture government strategy, then that would make it easier for people to accept ongoing changes. But there's been numerous occasions where we've seen officials come out and provide relatively coherent explanations about the strategy, only to have Trump flip around the next day and come out with something completely the opposite to what they said, or have to retract on those. So there are all the reasons why a couple of weeks ago we reduced our stocks and raised some cash and looked to say, well, where is there an opportunity to sort of get back into the market if we start seeing some of these reverses and look at the outcomes. So I'll get a little bit more into the outcomes later. What I did want to go through this time around is, what do you do in terms of these market downturns? What's your strategy, and what's our strategy in terms of running tactical portfolios within this? So first and foremost, you got to have a plan before you step into this. And if you don't already have a plan, well, you need to start writing one. And it's not the reactive plan. So is your overall plan as an investment in investment markets to follow trends? So basically, if the market's going up, are you going to jump in and buy? And the market's going to you're going to get out and sell. And if that's your plan, I'm probably not the right person to be talking to. First of all, you're probably more looking at some sort of technical trader or analysis like that. And you've got to acknowledge that you've got a very different mindset to longer term investors, and a very different tax outcome to what we're seeing for others. A lot of the real benefit from stocks is you buy a stock, it sits in your portfolio, it compounds over time. You don't have to have capital gains tax until you sell it, and you get that benefit of that money sort of compounding, over a long period of time, and you're getting back dividends, and you try to increase the stream, and off you go. The problem if you're trading is you're realizing these capital gains back and forth all the time, and you're always making these decisions about what you want to jump into and what you want to jump out of. But so that's a trading one. At the other end of the spectrum is just buy and hold. And there's a reasonable basis for some of this. Is it saying, well, if you're just investing money over time, particularly say within superannuation, and your money's coming out of your salary every month or every quarter and going into the market. Over long periods of time, you just buy the stocks as your money comes in, and you'll probably do fine. There's periods where you won't, but if you're talking 10, 20, 30 years time frames, then worrying too much about a 10% fall or a 10% rise here and there, can be counterproductive to your investment. It's just saying, I'm just going to take a set and forget. I'm going to buy whatever it is and just let the market carry me higher. The other one, which we tend to favor, certainly within our tactical portfolios, is the idea of leaning into cycles. Is you're not going 0 to 100, but you can go when markets are going looking good and valuations are explainable. You can have more stocks. And then when you start to run into times of turmoil, you can pull back and sort of raise your cash, increase your bonds, with the idea that when markets fall back, you'll then flip that cash back in at lower levels. You flip that cash and some of your bonds back into equities and sort of take the next leg higher. So that's where we sort of try to push. The other thing we focus on as well is this idea between quality and value, is that every time you want to buy a stock, you've got to make this assessment as to how good the quality of this and then how cheap or expensive it is. And why are you doing this is because it might be fine that, say, a car stock, ex-Tesla, an ex-Tesla car stock is trading on 5 times price to earnings ratio. So, a quarter of the valuation of the rest of the market. And it's cheap. But if it's not high quality because they just don't have control over their costs, facing all this competition from China, they've done nothing on the EV markets. And so they've got this problem that they just don't have the same, if the world moves into an EV bit, they're left behind. All these other issues. Well, maybe there's a reason not trading so cheap. So the idea is what we really want to try and find is stocks that are of a certain quality, and then trade that off versus the value. So for me, it's all about saying, happy to buy average quality stocks, but they need to be dirt cheap. And then when they go up in price, okay, they're the ones who are going to flip out and look for the next average quality stock or slightly above average quality stock that I can buy cheap. The second one then is, can I fill my portfolio with really high quality stocks at reasonable prices? And this is the downturns is where you need to have that shopping list of, these are the high quality companies I want to buy. Here's the prices that make sense to me. And when they hit these prices, yep, I'm going to buy them. I'm going to grab them. I'm going to stick them in the bottom drawer. And then I'm going to forget about it. And obviously make sure that you want to keep track and make sure they're still high quality companies. But as long as they're still high quality companies, that's where they're going. And I'm just going to rely on that compounding over time. So that's really what we're looking for, and we're using sort of these downturns to try and find, there's a stock, we've always wanted to buy that, but never been able to because it's so expensive. Now it's pulled back, it's more reasonable. And you often find in early stages of pullbacks that the stocks that get sold are often some of these high quality stocks early. So the idea is that there's a lot of the traders and companies that are the trend followers. They want liquid stocks. They want stocks that when things start going wrong, they can get out of quickly, or things go the opposite way to what their trading trend is, they can get out of quickly. And often these are the high quality stocks, and you see them sort of in the early stages. They might lose. You'll underperform relatively, but then as it rolls on, they're the ones that actually people are starting to jump in and buy. Whereas the lower quality ones, there's just not enough volume traded in them for people to jump in and out, and so they might outperform at the start and then end up underperforming after that. Okay, so that's one. I spoke a little bit about there being 2 decisions you need to make if you're going to be trading in and out. So it's not just getting it when to get out, it's also when to get back in again. And particularly for what we call retail investors, people who are investing at home, the problem they usually find is that they will panic when after markets have already panicked. So markets are down 10, 15%. That's the time they're sort of saying, "Oh, it's terrible. Now I need to sell out." And then they'll sit on the sidelines for far too long. And there's no plan about when to get back in. And having that plan about when to get back in, or what the triggers are, and then it could be 2-phase, it could be a time-based one, and it could be a valuation-based plan. Is that's your, that you need to have those triggers about, right, I said this is what I was going to do. I've got my written plan about, how I'm leaning into these cycles at this type of valuations. That's when I'm starting to buy in more. I'm going to buy in a little bit every month regardless. And whatever that plan might be, is that you've got your plan, and then you're sticking to your plan unless there's a genuine change and something different behind it. Because it's very easy to, as markets have their big tumble, to get sort of really worried about the ongoing effects, and it's difficult to come to that. No one's ever going to tell you, now is exactly the time to get back in. There will always be risks, at that point. The other one I'd focus on is this idea of action versus inaction. So if you've decided, say, that we've sort of taken 10 to 15% less equities now than what we ordinarily have. across most of our portfolios. So if we've made the decision, look, that's about the right level, is at that sort of 10 to 15%. There's always this temptation of like, oh, what can I do today? Is there something more I can do? Do I need to get out there and I'm worried about whatever event. Do I actually just have to keep selling day after day because I feel like I've got to do something to try and help myself? Versus actually saying, well, I chose this level and I think this is still the right level. I'm looking for whatever fundamentals that might show me things are getting worse, but there's a there's a right level, and then there's this idea that people feel as if I've got to do something. I've got to do something to save the situation, and that can often be counterproductive. Is that desire to keep going? It's more about pick your levels, pick the right weights, and then stick with that plan once you've got that going. And then the last one is this idea of particularly when you're running portfolios like we run. Individual stocks within our portfolio. So all of our clients have the individual stocks, and they sit within the portfolios. And I'm sure plenty of people listening in have that same type of structure within their own portfolios. Is that there is some pretty reasonable. You can often have some pretty reasonable tax gains. Just in the last couple of years, we're probably sitting on 100% plus in terms of stocks like Nvidia, and so. Or you pick a Microsoft or something like that, and so you go, yeah, look, I've been sitting on Microsoft for the last 10 years, and it's up 300% or something like that. Okay, I'm going to turn around and sell that stock. I am then going to realize a capital gain, and this is not a theoretical. So let's say you're going to have half that you're going to pay. So you've owned for a long time, so maybe it's only 100% gain or 150% gain that you're going to be taxed on. But if you're on 45%, there's a pretty reasonable amount of tax that you're going to be paying on that amount. And so, let's call it 20% of whatever the current valuation might be of Microsoft. So you're taking your Microsoft shares and you're basically saying, I know I'm going to get a 20% tax on this by selling down my Microsoft shares. That's guaranteed. Whereas the market falling 20%, well, that's theoretical still, or falling a further 20% to make that worthwhile. That from a tax perspective, a little bit better within super. You have much lower capital gains rates, but they're still significant. It's still a 10% capital gains tax. So and so what we find a lot of people then say is, well, given that, I'm just going to go through and sell all my losers instead. There's always some stocks, with no portfolio everything goes up. There's always some stocks up and some stocks down, or some stocks with much lower capital gains. Your problem there is often these losers are the ones that are actually there to counterbalance your portfolio when things go down. So some of the stocks that might be more like your utilities and your defensive stocks, which may not have performed that well over the last few years, but actually they're the ones, when you hit crises, are the ones that are bouncing up. And if you only sell those stocks as well, you already had a bit of a problem that Microsoft had already gone up by so much that now it was making a bigger and bigger proportion of your portfolio. You start selling everything that's not Microsoft in your portfolio, and next thing you know, you've got an even bigger problem in terms of bigger weight to that one stock. And so, there's definitely problems within that whole part around the amount of tax that you're definitely going to pay versus the amount of losses you might potentially make. So that's one part of it. The other part then is saying, well, I've made a deal about this as a big picture sense, but on a micro sense about what are you doing with stocks, I'd urge you to ignore the tax situation and do it as a fundamental view. If I don't think this stock is going to give me a good return over the next little while, then there is a reason to be selling that stock, as opposed to looking at a stock and going, it's gone up a lot, and I'm sitting on these big capital gains, and I actually don't really like the outlook for it, but I don't want to over the next year or two, but I don't want to raise the capital gains from it. So no, forget the capital gains. If you don't like the outlook for it, work out where it is and what other stocks you're going to be betting in. Make the investment decisions, not the decision based on investment, not based on the tax outcome. So I'm sort of giving you two sets of advice, but it's, I guess, at a micro level, forget the tax situation. Do what's right in terms of what stocks you should own and at what levels you should own them. But at the macro level, think about your portfolio trading in and trading out, and how much do you really want to create in these terms of these taxable losses, and how much are you giving up as a guaranteed loss within that. Okay, I've got a lot more to talk about on this, but let's go quickly to a sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. There's a bunch of articles you'll see out there from people talking about market valuations and where we are and all those types of things like that. The one thing I want to highlight with all this is valuations are dependent upon two things: the price and then the earnings that the companies are making. Both of those factors can change. And during genuine recessions, earnings will weaken significantly. And so and this is a problem of where we're at now, is that markets do look a bit expensive still. Like they're sort of 80th percentile in terms of where they are. So relatively expensive. But, if we're going through a soft landing, lots of good productivity growth and all these other factors, tax cuts and stuff like that, 80th percentiles might be the right price to be buying in at these levels. And actually, if you factor in some of the tax cuts and earnings hold up, then maybe we're back to the 70th or 75th percentile. So, that's you might be looking upon that as a positive. But if you are going to a significant downturn, earnings will get hit, and they will fall. It will fall 10, maybe 20% in terms of the earnings side. So what are we seeing right now is that the fundamentals are still good. We're really not seeing too much in terms of the way of weakness of forecasts yet. So keep in mind, though, that Trump's been in power for 6 weeks. There's been a lot of executive orders. I think a lot of people ourselves included, spent the first couple of weeks going, okay, look, we know there's going to be noise and smoke and mirrors and lots of factors that are showmanship. There's going to be lots of showmanship within it. That's the sort of the nature of his presidency. The question is, well, actually, are we at the stage now where we're starting to do real damage? And that's the assessment we made, is yes, we are on that stage. If that's the case, and we do start to see real damage, then these numbers will not hold up, and a lot of this valuation we're talking about is going to look worse than what's there. But as at last night, in terms of the what we can see in terms of earnings forecasts, the fundamentals still look pretty good for US stocks. I've got a chart up just showing that this blue line rising up over time in terms of how you that's the next 12 months worth of forecasts, and then the red lines are the individual years. And so of the latest red lines, we've got the 2025 numbers are still rising. We've got the 2026 numbers, and 2027 are starting to come away a little bit, but they're miles above 2025. So we're sort of talking about growth rates still of sort of 10% plus in terms of those. So they could come down quite substantially, and you're still going to get 5, 6, 7% growth without too much of a concern. So right now, keep in mind that these can change. Not particularly concerned about those. If you look at a longer term perspective, and so there's this measure called the cyclically adjusted price to earnings ratio. And what it does is it takes 10 years worth of earnings and sort of says, well, from 10 years ago, though, the earnings that were there are not comparable with today's earnings. And the reason why they're not comparable is because of inflation. So let's adjust those earnings up for inflation. And you get this cyclically adjusted price to earnings ratio. And that's, I've got a blue line on this chart, and that's massively high. It's sort of at these levels that haven't been seen for, basically been seen twice before. Once post-pandemic and another time in the middle of the tech boom. And my contention, though, is that they're not following. Sorry, let me simplify this. Is that those numbers don't adjust for changes in accounting standards and changes in the way companies do things. So what I've done in this second line, the cyclically adjusted PE, is I've made adjustments for those factors. One is there's a depreciation effect in terms of companies when back in the 1970s, they were, when you've got really high levels of inflation, your depreciation is understated. And so the earnings, which means the earnings are overstated. And what do I mean by that? So let's say we're in a period where we've got this high inflation. I built a factory for $10 million and it's going to last me 10 years and I'm depreciated $1 million a year. And it's 9 years later, now the factory, building a new factory isn't going to cost me 10 million, it's going to cost me 20. So, but I'm still only depreciating 1 million a year because I'm depreciating my last factory at cost. And so when I go and build this new factory, all of a sudden my depreciation is going to double on that. And so, so we need to adjust up those nines. I also go, well, let's not use 10 years worth of earnings. What I really want to use is I want to use post-tax earnings. I want to use 10 years worth of pre-tax earnings and apply the current tax rate. Because if I look at current 10 years worth of earnings, the first few years are getting taxed, say in the US, at 35% tax rates, where we know those tax rates have already fallen. So I'm interested in taking an average of the pre-tax earnings and then applying the current tax rate. The other thing that needs to be changed is there's companies didn't used to do buybacks. There was legal changes that sort of flipped around, and that suddenly changes a whole bunch of things as well. So it's actually saying, so then I'm going, well, do that pre-tax earnings and apply today's numbers of shares. So don't apply historical numbers of shares. Now you get this what's called cyclically adjusted PE 3.0, and that looks much more reasonable. It's still expensive, but much more reasonable versus it. But I guess sorry for the long explanation on this, but the big picture one is, look, if you're looking for long-term cyclically adjusted earnings to give you this signal to say, hey, they've fallen so far, now's the time to pin your ears back and buy. No, they haven't really. They're back to sort of 90th sort of percentile levels. And if you sort of factor in another tax cut coming, you can bring it back even further. And there probably is a corporate tax cut coming, but they're not sort of at these levels where, yes, it's so dirt cheap, you want to jump in to buy. And the other thing I do want to focus on, on that cyclically adjusted PE is, that's not such a great signal to use in terms of whether you should be buying right now or not. So, for example, if you said, okay, I'm only going to buy stocks when they're below their average. In the last, actually, I've got the number handy. In the last 20 years, actually, yes, I do. There's been one chance in the last 40 years. You've had one chance to buy stocks using that signal. And so, yeah, it's nice, and it's nice to look at those longer term averages. But if you're happy to have price signals that only give you buy or sell signals once every 40 years, then you've got a longer time horizon than I think most other investors. Okay, so that's the cyclically adjusted ones. Then let's have a look at the valuations you can get right now in terms of stocks, and I picked on the US markets. So if you look at what we're calling the mega cap, so these the top 8 stocks that they've actually used within this chart, which is your Meta, Microsoft, Nvidia, Apple, Amazon, Tesla also fit into that, is that they look expensive relative to the rest of the market. They have come back a long way from where the recent peaks. So that's the pink line at the top of this. So they're sort of trading, for anyone listening in, they're sort of trading at about 26 times. They have been as high as over 30 times or 38 times, sort of back in the early 2020s. And the sort of next level down is your large cap stocks, which is trading more like 21 times. And actually that large cap, I think, might even include those top 8. Then you get your mid cap and your small caps that are trading more like 15 times earnings. So your mid caps and your small cap stocks are actually not that expensive, especially relative to where they've traded in the history. They sort of look roughly about normal already. One thing you can do to that mega cap line though is you can take Tesla out. If you take Tesla out, that'll knock it down to closer to the market average. You might knock out from say 26 times back to sort of more like 22 or 23, just by pulling that one stock out. Tesla does make a big difference, and particularly in recent times, it became a much larger part of the index and then halved. There's I think from our perspective at least, there's a difference that you're looking at between the rest of those big stocks and looking at Tesla. So just to give you an idea of the numbers, your next 12-month numbers for all these stocks is, and I probably should have sorted this in a better way, but the Amazon and Apple are sort of up closer to 30 times, Microsoft 26 times, Nvidia's back at 24, Meta at 23, and actually if you adjust some of Meta's numbers, you can easily get it back to 20 or below, but based on some of what's core and what's not core. And then Alphabet at 18 times, sort of trading at less than the market. And these stocks have all got great growth. So you look forward into the sort of 12 to 24 months, the growth rate's there. And whereas Tesla is sort of double the valuation of all those. So markets, the big picture, markets look expensive at the large cap area. At the small cap area, much more sort of in train with some of the with a longer term history. If you though look at the growth side, and I've got a chart up which is just showing that the price to earnings ratio divided by the growth. Now I do have some issues with this ratio. I won't go into them, but at extreme, certainly at the edges, there shouldn't be a linear relationship. But anyway, the big picture one is they all look about the same when you do this measure. So what we're effectively saying is, yes, large cap stocks are priced much more than the small cap stocks, but actually large cap stocks is where all the growth has been. And the small cap stocks have been going backwards or sideways for the last couple of years, where these large cap stocks, that's where all the growth has really been, and particularly that sort of Magnificent Seven. And if you look at a stock like Nvidia, it's a 45-degree line for the earnings forecast that just keeps going up. And even as recent as the latest reporting a few weeks ago, we saw another jump in terms of the expected earnings for next year and the year after. So earnings looks good for this market, and I'll jump a little bit more into that. Can we expect that earnings? Which are the sectors that we can expect to fall in a minute? This question about will AI spending holding up? If I look at the world top 1,000 for 2025, and I break it into where's the growth coming from? Where was it coming from 6 months ago in terms of forecast, and where's it coming from now? Well, 6 months ago, we were looking at sort of about 12 to 13% growth, and 2.3% of that was coming from these big 8 stocks, and the rest was coming from the other 990 something odd stocks. If you look forward at today, then now it's come back to sort of more like 10% growth for this year. So still pretty reasonable. But as I said, if you are going into downturn, these numbers will be wildly different. But I guess the key thing I want to take from this is actually more of the earnings now is coming from the big tech side. They've actually been improving their forecasts over the last 6 months, whereas the rest of the market, the other 993 stocks, they've actually been going backwards in terms of your growth. You've been seeing downgrades there, particularly in Europe. Particularly in the US. Europe's actually been, they've been improving a little in terms of the forecasts. So, this idea of will the AI spending hold up is pretty key. I'm going to jump into sectors just quickly after this message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, I've got a few questions through. Are there any safe havens, and do we think this is market chaos or just a short-term blip? The short-term blip I'll get to in a minute, and there's a few different scenarios there. So I want to talk through what are the scenarios where it's short-term, what are the scenarios where it's potentially longer-term. In terms of safe havens, look, it depends on what you call a safe haven. So Europe has certainly been a safe haven to date. There's a lot going on in Europe, and I spoke a little bit about that last week, where both the euro's been going up. Markets have been pushing, stocks have been going up there, particularly some of the defense sectors. We've seen that German in particular, German growth looks like being they look like pushing through a package that's going to be significant in terms of the German government, which has been very, for the last 20 odd years, German government's been austerity, don't spend too much money. And they're, being one of the only economies within Europe that can actually afford to do stimulus. And so, the fact that they might be finally flipping around is quite significant. So I will get back to, but let me come back to that. Actually, sorry, Germany is probably one you can look back at our thoughts on that last week. If you're looking for safe havens, then bonds or cash, I think is your best option. I think in terms of safe havens, there's two parts to it. One is saying, can I find stocks that are going to hold up over the next few weeks or months in terms of, and going to more defensive sectors? That's one part of it. The more important one for me is, can I find stocks where the earnings are going to hold up? And I think that the valuations are not unreasonable. And that's the sectors I want to focus on right now, which is saying, there's four parts to these that we're looking upon as being areas that we're already invested in, and we're looking quite closely as to what do we think the issues are within this. The biggest one is AI. So I've spoken about this CapEx uncertainty within the US. Now that is largely around manufacturing. So the question for manufacturers is, and the service companies around those manufacturers is, are they just not going to do things? Are they just going to freeze and say, well, I don't know what's going on. I'm going to wait until I've got some clarity, and then I'm going to start spending again. And so you lose that, you get that sort of big hole in that market. And you also get danger within some of the, retail, particularly discretionary retail side. Within the artificial intelligence, though, the question is, will we see a cutback in terms of the amount of spending that's being done on that? That I'm less certain about. Not less certain. Well, I don't know. Let me clarify what I mean by less certain. I'm less certain that we're going to see a meaningful pullback in CapEx. It does still seem that companies are going to keep spending in terms of CapEx. We're starting to see some reasonable productivity breakthroughs within it. There is plenty of stories and use cases coming out of where companies are saving money in terms of the sort of more manual tasks that staff are doing. The question is, and I do think there's a large amount of fear of missing out within this. Governments are going to keep spending. There's military. The military side is almost certainly going to boom along as fast as it's been going, and then the corporate side is it's looked upon as a bit of a Cambrian explosion, and a little bit like the introduction of the internet. But the idea that, look, do I want to cut back on my AI spending right now and run the risk that my competitors don't, and actually I get caught, and next thing I know, they're miles ahead of me and their costs are lower, and it could be a company changing event. From what I can tell of companies, the uncertainty doesn't seem to be around the AI side. The uncertainty seems to be more around the what do I do with my supply chain type of issues. So that's one side of it. So the other danger you could see within the AI is that if a lot of the spend in AI is driven by startup companies. And so I'll use the analogy of the internet boom. So the internet boom is going on. Yeah, companies are still spending money on the internet, but at the peak of that whole boom, there was all these companies that raised money, they'd raised money on the stock market at crazy valuations, and they were basically pouring that money back into, pets.com and weird and wonderful websites to do all these different things, and just not making money. If that's the case, that's what's driving all this AI spend, is companies that have raised money and are just sitting there burning cash, then I've got more of a concern. That doesn't seem to be the case, though. There's certainly plenty of those companies out there, but the biggest spends seem to be from all of the from a lot of more traditional companies and governments and other factors where that doesn't seem to be a major concern. And then you've got Trump looking to throw more money at the at AI production and spending. So the AI side, I do think is a little bit of a safe haven-ish, and it's a chance to look at the stocks within that sector and try and find the higher quality ones and sort of pick up a bigger exposure to those. Next place is energy, and that is related to the AI. So energy will pull back with economic growth, but are we still going to see a transition to other forms of energy? I still think that's the case. There are battery breakthroughs coming thick and fast. They all the falling in terms of price that we're seeing within batteries is not changing. The falling in price of solar is still there. The falling price of wind. There's geothermal things going on. There's nuclear stuff going on. There's lots within that sector, and there's this increased demand from these data centers that is coming on as well. So, what does it mean? Does it mean that sector will grow as fast as it might have done in an economic boom? No, it won't, because you will see a fallback in energy demand because of these less manufacturing, less travel, all these other types of things fall into it. But I do think there's enough natural energy demand coming through from these data centers that that side will probably hold up in terms of the service companies within that. There's still going to be people needing to plug stuff in and turn it on and change the grid. You've still got Europe rapidly trying to get away from Russian gas and the changes that entails. So, look, could we see Russian gas turn back on again and lower energy prices in Europe? Absolutely, that could happen, and it's a pretty reasonable, whether you want to call it a risk case or a base case. It's certainly of a relatively high probability, but I don't think you're going to see the impetus to move away from Russian gas disappear. So it's more about saying, well, if we can get cheaper gas through Russian gas and keep these gas-fired power plants going while we go through that plan they've already set up to really transition away from it, then they'll do that. But I don't think there's this plan to say, oh great, Trump's in power now, we're all friends with Putin again. Let's hitch our wagon to the Russian energy market and rely on cheap gas. I don't think there's going to be a 180 within Europe at any time soon for that. So then you go, well, European growth. And that's another. So I guess I'm talking through in our portfolios where are we overweight within our stocks? Will European growth hold up? And that part, look, it's not as certain. I think there's certainly a place to watch. This German, just the brief summary of what's happened in Germany is you've had some parties run for government, not promising to spend money, probably the opposite, promising not to get out there and spend money. They've got into power. A far right party's picked up 20% of the vote and come second, and now the party that won with is looking at an alliance with some other parties to actually go out and start spending like meaningful amounts, like 1% of GDP on infrastructure, possibly another 1% on 1.2% on infrastructure over 10 years, potentially another 1% on defense spending, letting local governments borrow money, like it's a completely different plan, and the party is unlikely to be able to get that through once the new parliament starts. So they've got this two-week period now where we're in the old parliament, where they do have enough numbers with a coalition to actually ram this through, which is not something they ran on, and it's a sort of lame duck sessions. So it's a weird environment. So will that go through? Look, it looks like it will, but are you gonna bet your house on it? Well, there's risks around it still. So Europe, the growth looks good. Looks probably like lower energy prices for Europe, and they've really been struggling with these high energy prices. So that will sort of give them some benefit. They may not be the center of the trade war in terms of who knows. Trump could make them next enemy number one, and maybe he will. Maybe I'm being but at the moment it's Canada, Mexico, China that are really being hit, and so maybe there's some possibilities for Europe to not be as affected as the rest of the world. Some potential signs for Europe, but risks there as well. The other part of our portfolio, we've got a reasonable holding in still is some of the weight loss drugs. There's still we're not really looking at any major changes within that, and maybe there's less ability for people to afford it if we go through this economic downturn, but there's some pretty reasonable new drugs coming out as over the next year or two, in terms of going from injections to either oral or going from weekly injections to monthly injections, and lots of other factors that sort of look like relatively positive for that market. We think there's sort of limited downside in terms of what's been priced in, and there's this potential that maybe that's a significant upside in terms of how they get prescribed to people. And partly as well, I did mean to put this chart up, but I forgot to include it in the pack, sorry, is that there is there's some interesting charts of US obesity rates that have actually just flattened out. And so from a big picture sense, as we're talking about, what are the trends that are sort of hitting the market over the next sort of 4 or 5 years, we've got AI productivity. We have lots more automation and supply chains. There's a big spend on supply chains post-pandemic, and there's a lot of automation being done in factories. There's a productivity gain from that. There is productivity from US obesity rates flattening out, like just the fact that you just don't have to spend that same amount every year. You're not getting another 1% of people becoming obese every year. Even if that's just flattened out, that sort of takes some pressure off the health system, and potentially it might even start going back the other way, which is a big positive. Plus, there's other things going on, self-driving cars, other factors that are jumping up that can be real productivity game changers in terms of what we could see over the next sort of 5 years. So the underlying currents look good. Now it's this question about how much of a downturn are we in? Is it a short-term blip? Is it a long-term blip? And what's the what are the factors within that? So we're looking at 3 main scenarios that we're considering in terms of where this goes. So scenario number 1 is we end up in a stagflation, and that's probably the one markets are most worried about. Is that you've got pretty poor growth, everyone concerned about all these things, not recessionary, or at least not recessionary within that, but you're seeing inflation, and inflation is pushing through from changes in supply chains, tariffs, retaliatory tariffs, a global global slowdown from these higher prices. Now, stagflation is not great for stocks. Stocks are one of the better asset classes to be in overall if you're going to choose what you wanted to be in within this, because they do at least usually give you back that inflationary growth. So if inflation's happening and stocks are out there upping their prices every year, and you're less chance of falling behind if you're in stocks, whereas it can be quite poor for bonds, particularly in real terms. So you might be looking at sort of higher yields for bonds because the central banks aren't out there cutting rates because they're trying to get inflation under control. But on the flip side, if you've got inflation, running at high levels, then you might actually sort of be going backwards in sort of real terms on some of these bonds. So that's scenario number one. Is that scenario number two is the growth gets so bad that you don't even have to worry about inflation because you're into a recession and inflation gets wiped out, just through lack of demand. Maybe it'll appear again on the other side, but things are bad enough that that you sort of run into this inflation. Now that's going to be bad for stocks. It's growth that's low. Stocks are one of the more leveraged plays on economies, and typically in those scenarios, you will get earnings falling 10, 20% type levels, and that scenario though is probably good for bonds. You're looking at bonds, interest rates being cut to try and stimulate the market, and a better outcome for bonds in terms of falling yields. The last sort of most frequent scenario, or most likely scenario, is the idea that there's this Trump put out there or a Fed put. And what do we mean by that? Is that Trump will, at some point, when the market falls far enough, suddenly decide, actually, that's enough. I'm going to roll back whatever it is that's harming the market. I'm going to throw tax cuts at it. I'm going to throw more fiscal stimulus, and off we go. We're off and running in terms of the throwing money and watching the stock market go up. There's also the idea of this Fed put, which is the Fed, the US Fed, which is worried about inflation, worried about tariffs, worried about all these things, not lowering rates and not trying to juice the economy. Is that at some point they change their mind and they start throwing money at it. Now, how long are we away from these coming through? Well, the Fed put a while. You're probably 6 months away from it at least. Just things are going to be complicated for the next six months. They need to see a pretty reasonable downturn, and then they might come out with a look. We really need to start throwing stuff at this. But partly because the US economy has been so strong. It's been a pretty strong economy, and it's probably going to take a fair bit to knock it off its kilter. The Trump put, well, that could be 20 minutes away. It could be 20 months away. That's anyone's guess. So, if that happens at that point, that's sort of poor for long-term bonds. Maybe it might be all right for short-term bonds if part of that's part of what the Fed's doing is lowering the short-term rates. Good for stocks. At that point, you're going to want to be piling back into stocks. So how are we playing this? Is we're sort of saying, look, we're not quite sure which of these scenarios we're going into. We're very sort of focused on what's going on at the coalface. What can we see in terms of slowdowns? How big are these slowdowns going to be? Are they going to push us into this recessionary phase, or is it just going to be lower growth? And then will we see this Trump or Fed put? So really the key factors: growth, economic growth, trying to really focus on that, and the Trump put or the Fed put. When are they stepping in with the whatever it takes? We do think markets, in particular stock markets, are very much attuned to this whole idea. Is that the things we've learned from the last few crises, everything from back to the financial crisis, is as soon as you get these downturns, wait for the Fed or the US government to step in with the whatever it takes. They're probably going to overdo things, and you really want to be buying with your ears pinned back at that point. And so we've sort of raised some extra cash, maybe 10, 15% extra cash, with the idea that probably 15% extra cash within most of our portfolios, with the idea that we start seeing signs of that, we'll jump in and buy some more. If we see signs that economies are really starting to weaken and that this could be something much more dire, and that you're not getting any change in terms of the economic policies, and you're going into tit for tat tariffs, then we might lighten up a little bit more on stocks. But for the moment, we think we're probably fine. Yes, you can always, when markets go down, you can always have an argument as to why you should have owned less. But there are the risks are balanced as well in terms of trying to make sure you're not not panicking, flipping around, creating all these tax issues for yourself, not missing bounces. Given that Trump's tweets are sending markets up and down 2 or 3% in each direction, you don't really want to be completely out of the market in case you miss some of these bounces. So for us, it's it's about having a reasonable amount of cash and then trying to work out when the best time to deploy that cash is. Right, hopefully that's given it. I think that's all the questions we've got. Questions about Europe, but I think I've probably raised those. Thanks, Leo, for those questions. I think I'll probably address those. Just a reminder to everyone, hit the like and subscribe button if you like what you see. We are on all the major and minor podcast platforms. You can get all our research from nucleuswealth.com. Jump on there, give us you can subscribe to our newsletter and get this stuff in writing. We're on every Thursday, 12:30. Send us in any questions, and we love to hear from you about the types of things you're looking for. And hopefully that has given you a better feel for what we're doing and what you should be thinking about within your own portfolios. Thanks, everyone, and we'll catch you next week.